Hi, I'm Chris Slack. I'm the director of the Finance Consultancy and founder of Broker Illuminati. And today I'd like to share with you 10 mistakes that are very common when looking at calculating servicing for commercial loans. The first one, and many of these mistakes, tend to fall in that category of add backs. So add backs is a term that seems to be thrown around a lot by different accountants, brokers, and what have you. Let me tell you the first one. So the first mistake that people seem to make with add backs is that add backs are not one way, i.e. if you have depreciation and interest, which are the most common expenses that people like to add back, the flip side is that if you have extraordinary income that isn't as a result of your normal day-to-day operations of your business, then unfortunately that has to come off. So when we're looking at depreciation interest, yes, for most people that's looked at as an add back, but over the last 12 months, we have seen some of the most very common negative add backs, if you will, for nearly every business in Australia. And what I'm talking about there, of course, is cash flow boost, JobKeeper, and for those people that were doubly and triply unfortunate, insurance payments from fires, floods, and hail. A lot of areas in Australia are affected by that in the last 12 months. So number one mistake, add backs go both ways, unfortunately. Number two, there's a common expression amongst lenders. When you're justifying a position, add backs don't pay loans, profit does. So the second mistake, assuming that a lender is going to allow you to service a loan based on add backs alone, isn't going to work, certainly not post-COVID. The third mistake linked to the second is that add backs aren't always considered. So with certain lenders and certainly with certain transactions, there are larger thresholds. Certainly there's certain major banks and certain major lenders. Once you get seven figures, million or more, those add backs aren't going to be taken into account at all. The deal is, if you want our money, you've got to come to the party and service that loan, regardless of the add back. The fourth, again, I promise you, we're going to move on from add back soon. The fourth mistake that we see quite commonly, add backs aren't limited to depreciation and interest. It can also be considered for significant fluctuations in year-on-year expenses. The best way to do that is make sure you're looking through and analysing a company's profit and loss and looking at those expenses year on year. Now, again, getting back to our first mistake, you can't look at one without the other, but it's really important to sit through with your client and look through any large variances. My general rule would be 10%, but obviously if we're talking about a low base like accounting fees or something quite small, then yeah, 10% here or there doesn't matter so much. But if I saw a significant difference, $5,000, $10,000, $20,000, depending on the amount we're trying to service, it is important to call those out and actually go through that. So add backs aren't limited to depreciation and interest. There's certain industries whereby you might see variance that you can explain quite clearly. The fifth mistake, and most people are seeing this already, financials are only ever a snapshot in a particular point in time. Many of you would have seen that lenders are now moving towards bank statement servicing. At first, you thought it was just fintechs. Well, that's moved on. Many lenders now, they want your financials, but they're probably more interested in the bank statements. Bank statements might give a more real picture, along with your BAS statements, for example, that can be a little bit more relevant, and we'll build on that in a second. Our sixth mistake that people can make in terms of calculating servicing for commercial lending, commitments really need to be considered in the present day, so not limited to just the financials. When you've got, again, we talked about it before, when you've got your financials, it's a snapshot at a given point of time. So through that year, since the financials have been done, there might be new commitments, and also there might be commitments that have fallen off that won't be considered there. So you need to call those out in servicing to make sure you've given your client the best possible chance to be approved for finance. And remember, this isn't just for brokers, for brokers and accountants. It's important because everyone has their own idea of what constitutes add backs and servicing. But the bottom line is there's only one opinion that matters, and that's the lenders. Okay, number 7, you can't overlook multiple entities within a client group or tree. So they might be related by ownership. It may well be that there's significant loans between different entities. And what will happen is the lenders will see that. So generally in the first instance, it's through the balance sheet, but you may well see that in terms of the bank statements as well. And the next part to that, and the 8th mistake, and this is a biggie, certainly right now, you need to understand that bank statements show all evils. Unfortunately, habits, if you like going to the pub to pull your money out, if you like other extracurricular activities, whatever they may be, you will be pulled up on them. Locations, analysis, ATO payments, all of those things can be counterbalanced and checked off within bank statements. So you need to be careful about bank statements every time that's required, but it's more and more common for that very reason. The ninth mistake I see, every part of an analysis that you provide or every point that can be made in a negative, most of the time there might be a mitigant. And you need to make sure you look at mitigants. So when you're explaining a client situation and you're explaining on one side something that might not service, then there is mitigants around that. It might be new work coming through, might be expenses about to be removed, might be a sell down of assets, maybe deposit into an asset. It may well be other security that's offered. So there is additional mitigants in the case whereby a deal doesn't service, and it's important to call those out. And the last, very certainly not the least mistake that people seem to make is basically assuming that a deal has to service. So sure, most people will consider, everyone will look at these add backs and everyone look at servicing differently. I know a lot of people, certainly accountants and certain brokers I know too, they want to be able to hang their hat on one way. Well, the bottom line is we don't have control over that. We can't worry about what we can't control. So we need to make sure we look at our relationships with different lenders, make sure we have those chats and don't assume anything by a client. If you assume, then someone else will be looking after your client in no time at all. That's my 10 mistakes that can be made in terms of calculating servicing for commercial lending. I hope you've got something out of it. And if you've got any feedback or questions, always happy to hear them. Thanks for your time.